Good evening, everyone. Happy holidays, and welcome to the December 10th, 2014 broadcast of Bond Squad After Hours. As you can see, I am wearing my official Penn State football jersey after 3 years of suspension for some very unfortunate incidents. One of my two alma maters is now back in a bowl game. Yeah, we were 6-6, but better than my NFL team is doing, so we'll take what we can get. The good news is extended far beyond Happy Valley. As we saw in last week's non-farm payrolls data, the economy added over 300,000 jobs. This might be an outlier, it might not. We think it's probably an outlier. Underlying growth is probably closer to 250,000. But it indicates that businesses are willing to hire at the right cost. And what we're seeing here is a drop in CapEx, capital expenditures, and productivity. So what businesses appear to be doing, they're actually spending less on equipment and more on actual labor. Now, this can be done in businesses which need a lot of, let's say, manual labor or low-skilled labor, so where they can trade off between equipment or actual workers. And this is what we're seeing. Now, the labor market does appear to be getting tighter when you look at the available workers who are actually seeking jobs versus those versus job openings. But as we've said before, the labor market has to be viewed globally and in the face of technology. As long as that technology is waiting in the wings, it suppresses wage growth, or at least moderates its rise. So that's what we're seeing. So we're seeing jobs everywhere, but we're not seeing a whole lot in the way of wage growth. Now, there's been a lot of debate as to, will that continue? Is this a cyclical problem that's bound to come back as the economy picks up steam? It's partially cyclical. Look, we came out of the worst financial crisis since the Great Depression in the 1930s. To think that the recovery was going to be a typical rebound, it was a bit naive to think that. This was a generational event. So what happens is that we have a generational response, and what we're seeing now is a wageless recovery. Remember, back after the tech bubble, we had the jobless recovery. We had the economy picking up, but not many people being hired. Well, at the time, equipment purchases were big, right? We saw a lot of productivity. It wasn't until the Fed, with the help of some congressional, mortgage rules put in place, got the housing market going. And so what we saw there was, was a bubble fueled recovery, and to meet the demand, business needed both workers and they needed better equipment. So now, with workers desperate for jobs, although we're seeing a little bit, we're seeing the quit rate pick up a little bit. I mean, they're not so desperate; they're leaving for better jobs, hopefully. They're willing to work part-time jobs, willing to work for fairly low wages, maybe work 2 part-time jobs instead of 1 full-time. And we think this is actually kind of structural for right now. Remember, nothing is permanent. So the economy we saw from 1946 through 2007, look at every decade was different. So to think, there's a habit out there to look at it as one big economy. It was not. Each cycle was a different scenario unto itself. The 80s were quite different than the 70s, the 90s different than the 80s, and so on. So what we're seeing now, at least it's generational, and I think, and Bond Squad thinks, until the baby boomers are mostly left the workforce completely, turned 65, that's not going to happen for like another. God, the last baby boomer, is almost 20 years from now. Was it now? It's 64. So. Another 20 years about before they leave the labor force. So we're probably going to be faced with a situation where technology keeps advancing rapidly. That's what we see, and that's going to be a big competition for both service and manufacturing jobs. Global labor is going to be competition for manufacturing jobs. The stronger dollar makes foreign labor cheaper. That will probably change over time, back and forth, depending on interest rates and economic growth and whatnot. but we don't think that this is necessarily a temporary situation as much as generational. It'll change, but it's not going to change based on any cycle. There's too much of a blind adherence to technical charts. We'll look at a chart and we'll say, oh, the economy always rebounded X amount when this happened. We have to look at the context. We have to look at the context of everything.
To carry on traditions, to come together even when we're
Sorry, we had a little technical problem there. A little holiday message coming through. Sorry about that for the background noise. But this is probably more of a generational trend, and what we're seeing too is changes to the structure of the global economy. In case you haven't noticed and been under a rock for the past 6 months, oil prices have been dropping pretty dramatically. As of today's close, we had West Texas crude sitting at 61.54. Actually, it's trading right now again overseas, 61.55 as we look at our Bloomberg terminal. And we had OPEC, especially the Saudis, come out today and comment that they see consumption actually declining over the next year and no plans to cut production. And there was a great quote by a Saudi official who said, "Why would we cut production? It's not about price per barrel necessarily. It's also about how many barrels you can sell. You don't want to lose market share. Once you lose it, you don't get it back. And with more and more oil coming out of, let's say, less volatile parts of the world, U.S., Canada, even Mexico, it's not a foregone conclusion that people are going to line up for Saudi oil or Iranian oil or Venezuelan oil. So you don't want to lose that market share. Now, the Saudis can actually let oil drop pretty precipitously before they don't make money on it. Yeah, they have social spending, but they're well heeled. They have reserve capital. The Saudis can let oil go down a lot farther. So can a lot of U.S. producers. We're seeing wellhead prices in the Bakken. The wellhead price is what it costs you take it from the well. In the mid $50 a barrel range. And they're profitable at those levels. It seems that and we're not commodity traders, but it seems that the established producing wells can be profitable with oil a lot lower than where it is today. The problem comes from new exploration and production, the wells that haven't been drilled yet, and with oil at these levels, it makes it in certain instances cost prohibitive. And that's where the real weakness is. So it's all these exploration companies and small oil service companies that could come under pressure. And we're seeing that in the junk market, the junk loan market. There's a lot of junk loans and fair amount of junk bonds that are issued by oil services companies, oil drillers, the smaller ones. And those could be really in peril, especially if they're relying on constant exploration and development of new areas. That might not be feasible at the present time with the present technology and cost structures, at today's prices. So that's where the weakness is. But we've seen the weakness in securities prices go across the board. We're seeing natural gas pipeline companies and natural gas and pipeline indices just get hammered. Well, we chalk this up to what's become in the investment world as a prepackaged investment world. So now nobody picks out individual opportunities. Nobody picks out individual securities. We'll buy a portfolio, sight unseen, not custom built. Intelligently put together by quantitative mathematicians and maybe even a computer program. And we'll buy energy, and we'll buy tech, and we'll buy healthcare and biotech. And we'll buy that. Are we making any specific choices? No, we're just buying whole sectors of the market. And when the Fed has its foot to the accelerator, it doesn't really matter. Almost all asset prices will perform pretty well, if not very well. Well, what we're seeing here is the Fed's taking its foot off the gas a bit, and now these companies are going to have to survive on their own business models, not on investor capital, not on leverage that keeps coming in. And That's where it could be a problem for some of these weaker oil drillers and service companies, because if, and we say if because it's not a foregone conclusion that the Fed raises rates, but if the Fed starts to raise rates and the revenues start to fall off from these weaker, highly leveraged oil service companies and producers, what we could see is some of these companies having difficulty servicing their debt. Now, that might not be much of a problem for a while. It takes a while. Some of these are well below their floor coupons, as it were, on these especially on these floating rates. But just a revenue drop off alone is going to put them under pressure, and we're seeing that. What's frustrating is to watch good companies and even companies not involved in the actual exploration of new opportunities also get hammered along, and this baby's going out with the bathwater, and remember, if you're invested in a vehicle that's not an actual security, it's a group of securities or a portfolio or whatnot, and you want to sell, well, what do? You call up your advisor, or you go directly yourself if you're self-managed, and you sell it out. Now, that portfolio manager can't just sell the bad stuff. One, in this environment, you might not get a bid on the bad stuff. Liquidity is horrendous in the high-yield debt market right now. Some of it is holiday. Most of it is structural, and we've discussed it before, and we'll touch on it a bit before we close tonight. So you have to sell the what you can get a bid on, and sometimes that's the better stuff. So we're starting to see asset prices decline among strong producers and even among energy companies that involve mostly natural gas. When we see ExxonMobil and Chevron Texaco and ConocoPhillips get hit because of this, we're not making recommendations here on this broadcast, but one would think that the bigger guys could actually take advantage of this situation and brush aside or even buy out at attractive prices the weaker participants who might have access to good resources but can't develop them with credit spreads, with their borrowing costs rising. And remember, interest rates have fallen, but the borrowing costs for these high yield credits have gone up. The spreads have widened, and we expect that to continue. We're looking at Bank of America Merrill research today, and year to date, single B U.S. corporate debt on average has a total return of 1%. When you take out the coupon payments, the price performance alone is down almost 5.5%. All right, high yield is an equity play with a coupon. It's not designed. It's not designed to be an income enhancement vehicle. All right. Yeah, some people use it as that, but that's not its real cause. Excuse me. Sorry about that. Notes malfunction. Okay. So it's really an equity with a coupon. And people are going to start getting a lesson as to what high yield is really about. That being said, there are good companies, and like I said, which are getting battered, but their balance sheets are fine. They have plenty of capital. They don't have debt coming due in the near future. And that's important because you don't want to have to refinance into a I won't say a hostile environment, but into a less advantageous environment. And right now we're seeing that, in the high yield sector, so we have our idea. If you want ideas, give us a call at the office, 570-424-1555, and we're happy to have a one-on-one discussion with you. But there are some opportunities, but it's not for the faint of heart, interest rates are a subject that can be quite confusing for some people. They hear rates are going to go up, and they think all rates go up. All right, short end of the curve, make it simple. Short end of the curve run by the Fed, except for times of QE, long end of the curve is influenced by inflation pressures. All right, it's also influenced by capital flows, which can also be influenced by inflation pressures. So what we're seeing today, or in this environment, is money flooding in from overseas. It's going into equities, but it's going into U.S. Treasuries. If like we said in previous broadcasts and in many of our reports, if you're in Europe and you can get 75 to 80 basis points in the German 10-year and the euro keeps losing value, or you can go to the U.S. and get over 2% for U.S. Treasury and the dollar keeps increasing in value, where would you go? And we're seeing that, and we saw that today on the 10-year Treasury note auction. The bid to cover was 2.97. I believe it was, if I remember right, if I hear it was 2.69 average of the past 10 sales. And it sold at a yield of 221 at the auction. Now this was a reopening of a new issue from last month, and as of close of business today, the 10-year U.S. Treasury yield was at 2.153%. At this time last year, it was approaching 3. All right. There's global deflation and disinflation out there. We're in a global economy. No economy and no bond market can decouple from another. Some economies like ours might be strong enough to keep pushing forward against the headwinds, but the headwinds will buffet the U.S. economy, will influence our interest rates. So if the Fed does decide to start raising rates next year or in 2016, we could be in for a scenario which flattens the yield curve, and we can see the curve flatten at or below 3% even. So these calls for these real high rates, the equity guys keep coming out. Oh, we'll head forwards eventually. They're going to do it. Where? We heard one guy in the media yesterday saying, QE's worked magic here, and we know who he is, and we know what firm he's from. We don't want to embarrass him here, but saying, oh, QE's worked magic here. It's going to work magic in Japan. It's going to work magic in Europe. Yeah, it's gonna fix their population problem. The population contraction in Japan. It's gonna fix their very strict and uncompetitive business practices in Europe. It's not gonna fix that. So, and you can drop money from a helicopter like Ben Bernanke was famously chided for years ago. They called him Helicopter Ben. But it wouldn't drive much growth over in Japan or Europe. Their problems are clearly structural. So the QE over there just might be necessary just to keep them, from contracting. That might be normal policy, quote unquote normal. So we don't think that that QE is going to do much to boost the economy higher, but if it's implemented, it might keep it out of recession. Although Japan's been doing QE, heck, Japan's buying U.S. equities now, to try to get things going. Talking about QE, right? It's a structural problem, folks. So that's what we're seeing. We think that there's more pain to come in the energy space. There's just no bidders out there, no bidders whatsoever. We were actually contacted by traders. One trader in particular was practically, I wouldn't say begging, but it's kind of a tone of desperation. Are you involved in anything? Can I help you with something? Bid, offer. There's no trading volume, and we can point that back to financial regulations. Now, we're not going to criticize. Look, we're at Bond Squad, our official line is the fewer regulations, the better, within reason. And during the financial crisis, time I was working for one of the largest banks and arguably one of the largest offenders in the mortgage debacle. And the banks took liberties. They stretched, they pushed the envelope, and that gave a window for the regulators to come in and be, strict or even too strict with capital regulations and restrictions on proprietary trading. Well, all that is combining to take liquidity out of the market. So try to get a bid out there on some of the stuff, and it's impossible. And that's adding to the volatility that we're seeing in high yield. Part of the volatility is structural. It was way too rich before. No, the spreads weren't as tight as they were back in 2007, but God, that's the tightest they've ever been. We were next to that. We heard some wholesalers go around saying that's not back there yet, and they probably can still go there. Yeah, okay. And the Mets won 8 games back in 1986, and we're still waiting for a repeat of that. So. Nothing is repeatable just because it happened, and that's what it's frustrating to see and to listen to strategists and economists and analysts keep looking back to the recent past and looking for signs that we're on that precipice of repeating that. Our view is look back to the days following Glass-Steagall, when the last time that banking regulations were really strict. That's probably more accurate than looking to see what what banks did, what the economy did, following the tech bubble, or or following the crash of '87, or the Gulf War in '91. It's a different situation. This was a financial catastrophe that we're recovering from, and we're seeing a generational change. So, Bond Squad's outlook, and I don't want to tip it off too much because we are composing our 2015 outlook as we speak, is that this coming year, junk bonds, probably the return you get is probably going to be from the coupon, and we cannot promise you that the prices don't decline further. The saving grace there might be that we don't think long-term Treasury yields are going higher. The curve starts to flatten. You'll probably get some spread widening though, but for the most part, your coupon, your returns probably would be your coupon, or your coupon minus your price depreciation, at least for a while. How far this goes, we cannot say. Old saying, when the tide goes out, we see who's swimming naked. We've used that line time and time again, and we're going to find out. We're going to find out who the weak players are and who just looks weak, and how it shakes out might be surprising. That's why, even with the best analysis, high yield is not an investment for the faint of heart. It should not be used as a way for moderate or conservative investors to juice for yield in troubled times. You hear these guys on TV all the time say, "Oh yeah, it's safer now. You can do this. You have to." What do? Buy treasuries? No, you don't have to buy treasuries. There's other ways to get yield without taking too much credit risk. It seems everybody's talking their derivative books out there. We don't have a derivative book, so there's nothing to talk there. And we don't broadcast ideas. We'll give ideas, when asked. We're not going to talk our books or the books of our accounts that we manage. Not at all. So, just to sum it up, we do not see rates rising. Liquidity is going to be very thin heading into this year. Our concern is that we see a correction in risk assets. We're already seeing it in high yield, maybe see it in equities the beginning of next year, sometime in the first quarter, maybe even in January. We had a lot of upward pressure from money coming in from overseas and from portfolio managers chasing return. They were lagging in indexes. That could fade. You might get some tax loss selling at the beginning of the year or the end of this year. So we think there might be a pullback in this. We just think the situation is renormalizing, and it was bound to happen. Trees don't grow to the sky. People, like to think that they will, and they're probably not. So with that, we'll end it a little early tonight. We don't want to just keep rambling on and on here. Just keep your eye on the banks. We'll add something about the banks. For 2 years now, at least, we've heard pundit after pundit after pundit say, now the banks will do well. Now the banks will do well. Now the Fed will raise rates and the banks will do well. All right. Our opinion was, all right, why? Why are they going to do well from a profit standpoint? They can't make money trading. They've been restricted. You just heard Citi and Bank of America come out and say the trading revenue is going to be down. The proprietary trading is restricted. You have to hold higher levels of capital versus your credit market exposure. So do you want to tie up that capital doing that? So you're going to generate most of your profit from traditional banking, and you have to. And now the Fed, and this wasn't unexpected by us, but now the Fed comes out and says that they're going to they raise the capital requirements, make it tougher. Unless you want to shrink. So if you're a big bank, you're going to have more reserve capital. I'm going to limit your short-term financing options. Well, how are you buying back shares? How are you raising your dividend? And you're probably not. I'm not doing much of it. So you basically, as we said before, the banks have become utilities without the dividend. So from an equity standpoint, we don't think banks are a great opportunity. The large money center banks anyway. From a bond perspective, well, they're better capitalized than they've probably ever been in the history of the country. The odds of a large money center bank, defaulting, even in the 2008 scenario, is vastly diminished from what it was before, and because of various other restrictions on risk taking and underwriting standards, at least in the mortgage market, not the auto loan market, which, is still fog and mirror, get a loan. That's going to be fun to look at, 3 to 5 years from now. But, it's unlikely that we see a 2008 repeat. So, we look at these senior notes from the various large money center banks that are rated, mid to high triple B or low to mid single A. And we're like thinking, well, the odds of senior debt defaulting is probably much less than what the credit rating indicates, almost like looking at a municipal, I guess, but municipal is a different rating methodology. So, I mean, if you want to pick up yield, it's without taking that much credit risk in the corporate market, look at some of the large money center bank bonds. You're not going to make a fortune trading them, but you'll be able to clip the coupons. And after all, that's what fixed income investing is supposed to be. It's not about share price on a vehicle or a bond price, it's about clipping the coupon, having steady income, and collecting par at maturity. That's our timer here. We don't want to go too long here, so a bit loud, isn't it though? So with that, we'll say goodnight. If you have any questions, please call us at 570-424-1555 or email us at thomas.byrne@WSNM. That's Whiskey Sam, the word and, A-N-D, M.com. All right, thomas.byrne@WSNM.com. And with that, have a great night. And tune in next week, because next Wednesday is the FOMC meeting, and that will be the subject of our broadcast, as well as our holiday special. And with that, have a very good night, an enjoyable weekend. Happy holidays. Thank you.